All right, we'll get started here. We're just at 100 attendees right now and 5 panelists. Good afternoon, everybody, and good morning to those Central Time and earlier. Thank you for joining us today. This is Brian Funke with HDA Truck Pride. I will be your moderator for the session today. A few items before we get introduced our first speakers. Just a few things. One is we have all microphones disabled during the webinar. So we'll be utilizing chat and the Q&A function in the Zoom panel to submit questions and things like that. You'll also see my email and my phone, so you can text me or email me during the presentation to do that. These are identified on the screen right now. Hopefully you all can share it. You all can see the presentation right now. If you do have a question during, please don't hesitate, just submit them in. We will have a Q&A at the end of the presentation, but the more questions, the better, and we'll just consolidate them as we go through the presentation. We will also be recording this presentation. I'll start that recording here in just a minute, and we'll be able to share that with everybody as we, over the next couple of days here, we'll load it to our website and send it to a place that everybody can get to it. And okay, good. So recording has already started. We're good to go. Okay. So first up for our agenda, we first have Tina Hubbard, our president of HDA Truck Pride, will kick it off with just a few words. From there, we'll move on to our BKD. We have 2 speakers from BKD. It's our accounting and tax audit consulting firm that we work with. They'll cover the tax postponement rules, the Family First Act, as well as the CARES Act today. We will have another webinar scheduled for next week to cover the PPP portion of the CARES Act and talk a little bit more about loans and that type of thing. We'll follow that up with a Q&A to get as many questions as we can answered for you today, and then follow up those over the next couple of days here via email or phone to make sure everybody has the answers that they need. Our goal today is to help educate and clarify the new acts to help you identify where you can take advantage of them in your businesses. With that, I'll hand it over to Tina, and she can kick off the presentation.
Thank you, Brian. Ladies and gentlemen, thank you for joining us today. These certainly are challenging times. We're faced with uncertainty and stressful situations that none of us have ever had to manage through before. And we're all hopeful that this curve will flatten out soon so we can regain some degree of quote-unquote normalcy. All of us at HDA Truck Pride are doing well and virus-free. I would like to recognize our staff for doing an incredible job adjusting to their new work environments. With some advanced planning, our technology department was able to equip all employees overnight with the necessary tools to allow everyone to maintain their productivity and workflow. Well, once we got through that first day and got it under our belts. Ken and the CV Logistics team have a minimal crew keeping the CVL operation running so we can fulfill member orders. Sue Nold, our controller, Jackie Zicon from Accounts Receivable, and Matt Cullen from IT, they continue to still work in the St. Louis office while practicing social distancing to handle the several manual processes we still have. We hope that your families and all of your team members are well. I would like to take a few minutes before we start the webinar and the main presentation to cover just a few key topics. First of all, financials. As HDA Truck Pride wrapped up our first quarter, we finished up 7.5%. And looking from insight from our members as to how you finished first quarter and what you see going forward, although I know none of us have crystal balls. Some good news for these irrational times, up 7.5%. So I wanted to say thank you to all of you for supporting HDA Truck Pride and our supplier partners. As we progress through the next month or two, we are focused on helping our members manage through the challenges. We have limited our communications to COVID-19 related information and any key program additions or updates that impact the membership. A few members asked that I remind folks that Permatex has Spray 9 and Penray has Claire disinfectant products that help with disinfecting surfaces, whether they're in a cab or on your countertops, to help control this COVID-19 situation. Secondly, I'd like to talk about our annual meeting. Postponing this meeting was an extremely difficult decision, but obviously the right one. While nothing beats face-to-face networking with fellow members and suppliers, we do have some key and critical projects that need to be communicated to everyone. And in a minimum, we will host a virtual meeting. We've identified a virtual meeting platform that also gives us the opportunity to host a virtual trade show, allowing our members and suppliers to engage with one another. Maybe we'll even create an HCA Truck Pride video game. It's a bit premature yet to set the date and time for the meeting, but we will keep you informed as things progress. Staying with the topic of annual meeting, I'd like to show you our next slide, which is show specials. We do have suppliers that are still offering show specials. All show specials are listed on the website. You can see here on the slide, and are included in Nikki's Monday morning email communication. Please note that some specials have extended timelines. Our CV Logistics specials offer free freight for all orders for April and May, along with a minimum 5% discount and additional discounts on designated lines. Next, I'd like to talk about cash flow. It is particularly important to maintain a solid cash flow during these turbulent times. We recently sent out information regarding corporate billing. Several members and truck service experts utilize their services and are thankful for having a third party managing their receivables. No better time than the present to contact corporate billing. You can see Sam's contact name and information on the slide. Their services are available to members as well as truck service experts. HCA Truck Pride sent a notice to all Central Pay members reminding everyone of the imperative nature for keeping your accounts with us current as we manage through these next weeks. COVID-19. We have shared some communications with you, best practices, mandate summaries, and links related to COVID-19. All of that information can be found on our website. When you go to the main screen of our website, you can click on COVID-19 and it will take you to the link for state and local information. You can also log in and go to our section called 2020 Coronavirus, where all of the COVID-19 materials, along with a copy of today's presentation, can be found. Just one more thing before we get to the main topic. What are other members doing? To lighten the mood just a bit, I wanted to share with you what one of our members is doing to bring some humor to the overall mood of things. Ronnie Savoy and the team at Triple R Truck Parts in Eddystone, Pennsylvania, has this sign outside of his building. All purchases over $50 get a free roll of toilet paper. And it's not just a ploy. When you go inside and place an order for $50, the kicker is it's really true. You can see here the actual roll of toilet paper with a personal label for these really crappy times. And now I'll turn it over to Brian Funke, our COO, to facilitate the webinar you've all been waiting for. Stay safe and thank you.
Thank you, Tina. What a great little gimmick from you guys over at Triple R. Nice work, Ronnie. All right, so we'll move on to the main content here. We should be right around 40 minutes. Our expectation here is to go through presentation until about quarter of, and then we'll allow the last 10 or 15 minutes for questions. So without further ado, I'm going to introduce first Julia Dingle. She's a CPA and manager of the National Office in Kansas City for BKD. She works closely with the Director of Tax Quality Control on firm-wide tax projects and support-related tasks. Before joining the National Office in 2017, she worked in their Kansas City office, providing tax services to a variety of businesses and individuals. She's a member of the American Institute of CPAs and graduated from Truman State University in Missouri with a bachelor's in accounting and a master's in accounting with a taxation emphasis. She's also known as a virus expert with some other descriptors there within the BKD family today. Our other presenter will be Jesse Palmer. Jesse is partner in BKD's National Office Tax Department and serves as the firm's Director of Tax Quality Control. His responsibilities include quality control, risk management, and day-to-day administration of the firm's tax practice. He also provides technical support and training to BKD's tax professionals. Jesse serves as co-chair of the firm's tax committee and works closely with the National Tax Director on firm-wide tax-related growth initiatives. Before joining the national office in 2008, he worked in the Kansas City office and focused on tax consulting with manufacturing and distribution organizations and auto dealerships. Jesse assisted clients with general tax and business consulting and performed corporate and individual tax planning for closely held businesses. He is a member of American Institute of CPAs and Missouri Society of CPAs. He previously served on AICPA's Tax Practice Responsibilities Committee and is a graduate of University of Missouri with a BS and master's degree in accounting. With that, I'll hand it over to Jesse to take the presentation.
All right. Well, thank you, Brian, and good afternoon or morning, I guess, for some of you, but happy to be on the call here today and try to put a little bit of sanity around everything that's been going on. Just echoing some of Tina's comments, certainly these have been challenging times for many of you, both businesses and personally. I mentioned on a webcast the other day, I as a tax person, I never would have thought I'd be giving presentations on April 1st or late March in the middle of tax season, but certainly here we are with the extraordinary times we're in. And really the goal today is to try to not cover every single thing in these legislative acts. The CARES Act alone was just almost 900 pages in length, so certainly a lot of information to digest and lots of questions out there. I know many of you have submitted questions already that we'll try to address as many of those as we can today, but really just want to give some overview in terms of the tax day postponement, in terms of some IRS announcements around that regard, talk a little bit about the Families First and Coronavirus Response Act, which was kind of the phase 2 stimulus bill that was passed a couple of weeks ago, and some of the key provisions in that. And then talk about some of the items in the CARES Act that was just signed into law last week very quickly, and has a lot of tax implications and other potential loan and other type of relief through the SBA loans and so forth. And then just kind of a quick overview of what's potentially coming next. There's still a lot of talk about further stimulus and so forth, and just kind of give you a sense of what we know there. So I'll just kick it off with the first topic, and that's just the tax day postponement. Obviously, we're all very familiar with the April 15 due date for our individual returns, and for corporations, C corporations, 4/15 is the due date as well. And certainly with the timing of this pandemic and all the stay-at-home orders and other shelter in place and social distancing and everything going on, that obviously makes it very difficult for taxpayers to be able to get their information to their accountants, or if they're doing it themselves, getting the information. Certainly if they're paper filing, getting things to the post office and so forth. And certainly just from an economic perspective, just challenges with, how am I going to pay my bills and so forth, and having also a concern about, a tax liability coming due here on April 15th. So in response to that, the IRS came out with an announcement a few weeks back that provided relief for payment of income tax liabilities, not only with your 2019 return, but if you are a taxpayer that is required to make estimated tax payments, that first quarter estimate is also postponed both until July 15th, which was great, but the initial guidance did not provide any relief from a filing obligation to either file a return still or file an extension by the April 15th deadline. So after lots of pushback and communications with different legislators and so forth in D.C., the IRS did finally come out and provide some additional relief there, and basically said, okay, now if you're a taxpayer that has a income tax filing obligation with a return due April 15th, you don't have to do anything until July 15th. So basically the way it stands now is I don't have to file a return or an extension or make any payment if I have a tax due for my first quarter or first quarter estimate for 20. That has all been postponed until July 15th now. Also, initially, there was some caps that they put in place in terms of how much could be deferred or postponed, and it was $1 million for individuals, $10 million for corporations. Fortunately, in the subsequent announcement, they removed those limits, so regardless of how much you owe, that can now all be deferred until July 15th. As I mentioned, it applies to all taxpayers, so there is no carve-outs or anything. So basically, any taxpayer that has an income tax filing obligation will qualify. And as I mentioned, it's also available for the 2020 first quarter estimate. Now, obviously that's great, but many of you are in different states, and certainly not only do you have a federal filing obligation, you have a state filing obligation in most cases, unless you're one of the lucky Texas residents or Florida where there is no income tax. But with those states, certainly it's not automatic that they're also going to postpone it. So there's just been a flurry of announcements kind of piecemeal by the states in terms of how they're going to respond. And I believe as recently, I think 39 out of the 42 states with an income tax filing obligation have announced some sort of postponement. The good news is most of them have basically followed the federal and said, we're also going to let you postpone any state filing or payment until July 15th. There are a few states that aren't quite the same. I know one, Mississippi, for instance, only did a postponement to May 15th. So we don't have complete uniformity among the states, but certainly there is some relief there as well. And just if you have a state filing obligation, something you'll just want to make sure you talk to your tax advisor, make sure that there isn't something that needs to be addressed from a state perspective. Okay, next slide, Brian, if you can. The IRS has also come out with various FAQs in terms of these deadline postponements, because there have been a lot of questions that they have addressed, and there's certainly still a lot of questions out there. But some of the main ones they've clarified is, does this relief provide more time to contribute money to an IRA for 2019? Because typically you have up until your filing due date to make a contribution to an IRA for the prior year, for 2019. And they did come out and say, yes, that has also been postponed. So you do now have until July 15th to make that contribution for 19. There's also been a lot of questions about other forms, such as gift tax returns or state returns or exempt organization returns, and just a lot of different other forms that have a 4/15 date. So they have come out and provided a little more guidance there in terms of what other forms this might impact. Also for corporations that have fiscal years, particularly June 30 year-end corporations that might have an extended due date of April 15th, that has also been postponed until July 15th. So again, there's a link on your slide there to the FAQs. And as I mentioned, they did come out with a third announcement that has also postponed the federal due date for gift tax return filing. So if you have a gift tax filing obligation or liability, that now gets postponed to July 15th as well. So yeah, like I said, just a lot going on there in terms of IRS announcements and so forth. And I don't think we're going to, I'm sure we're going to see many more coming out. I know one that was still unaddressed, or at least the way they've announced it now, is your second quarter estimate, which is typically due at June 15. As of now, that has not been postponed. So we're kind of in a really odd situation where my first quarter estimate is actually due after my second quarter estimate. So hopefully we'll get a little more guidance there in terms of how that's all going to work. So the next topic, and I'll turn it over to Julia, or the virus queen. Julia's going to get me back, I'm sure, at some point for giving her that nickname, but she is going to now cover some of the Family First Act provisions. So, Julia?
All right, thanks, Jesse. So as Jesse mentioned, on March 18th, 2020, President Trump signed into law the Families First Coronavirus Response Act. And that was the second piece of legislation that Congress passed in response to the COVID-19 outbreak. And that act, it mandates that employers with fewer than 500 employees must provide up to 12 weeks of paid leave for employees who are unable to work or telework due to circumstances related to COVID-19. And it also offsets that cost of providing the required leave with some refundable tax credits against employment tax. And according to Notice 2020-21, and the link is up there on your slides, the paid leave provisions under this act are effective April 1st and will only apply to wages paid for the period beginning on April 1st and then ending on December 31st of 2020. Now, the IRS and the Department of Labor have indicated that they intend to issue a temporary non-enforcement policy that will provide a period of time for employers to actually come into compliance with the Act. And under that policy, the Department of Labor doesn't intend to bring any enforcement actions against an employer for violations of the Act, assuming that the employer was acting reasonably and in good faith and at least attempting to comply with the Act and get their affairs in order to be able to start providing that leave. But instead of bringing those enforcement actions, labor will take that time to focus on just compliance assistance and helping employers get up to speed during that 30-day period. So an employer, which includes a religious or nonprofit organization with fewer than 50 employees, will be exempt from providing this emergency paid leave. If doing so would jeopardize the viability of the small business as a going concern. So this determination needs to be made by an authorized officer of the business as well as documented. So for example, if complying with the provision of paid sick leave or the expanded family and medical leave would result in the small business's expenses and financial obligations actually exceeding the available business revenues and thus causing the small business to cease operations at a minimal capacity, that would rise to the level of a hardship exemption. And based on the Department of Labor guidance issued thus far, that would allow them to be exempt from these provisions. All right, next slide, please. All right, so the Families First Act expands the Family Medical Leave Act to provide, again, up to 12 weeks of FMLA leave for employees who are unable to work or telework due to a minor child's school or daycare being closed as a result of COVID-19. Now, those first 10 days of that leave will be unpaid, but this kind of interplays with the paid leave section under the Families First Act because an employee can elect to use either paid sick leave, accrued vacation, or other forms of paid time off. Instead of taking that leave unpaid, they can swap it out with some other forms of paid leave. So for example, if Jane is no longer has someone to watch her child, she doesn't have childcare because her 8-year-old son's school is closed for the rest of the year due to COVID-19. And then the nature of her job is such that she can't go into work or work remotely, again, because she doesn't have childcare. So if Jane doesn't have any accrued sick or vacation days left, she can use the paid sick leave under the Families First Act for those first 2 weeks of unpaid leave, and then transition into that FMLA leave for the remaining 10 weeks. Now, if Jane did have accrued vacation time, her employer can't make her use that time instead of taking the paid leave under the Families First Act. It's up to the employee to choose which type of leave they want to substitute in for those first 10 days, and then before they transition into that expanded family medical leave. So if your company or organization is subject to the Families First Act, you're only required by this law to provide up to $200 per day and $10,000 total for each employee. And wages paid under this provision are also limited to 2/3 of an employee's regular pay. But should you choose to, you may provide more out of the kindness of your heart. But as we'll discuss later, your corresponding payroll tax credit is still going to be capped at those statutory limits. So anything over these caps is expected to be paid out of your own budgets. This part of the Families First Act relies on the rules under the FMLA regulations and the Fair Labor Standards Act. So just a note here, if you have employees that you expect to, or maybe they're already attempting to use this type of FMLA leave, we recommend that you consult an attorney that specializes in FMLA rules. All right, so on the next slide, we'll get into the emergency paid sick leave. Now this provision is a bit broader, mostly because there is a list of 6 types of leave that qualify for this benefit, and it's for up to 80 hours of paid sick leave for full-time employees. Now part-time employees are also eligible. They're eligible to take the average number of hours that they would generally work over a 2-week period. And another note is that the paid sick time under this provision will not carry over from year to year. Okay, so I'm not going to read this list to you. You guys will have this slide, these slides available to you to refer to for your reference. But you can essentially break down this list into 2 buckets. So the first 3 types of leave is related to leave that you need to take care of yourself because of impacts due to COVID-19. And then the next 2 relate to leave to take care of someone else. So if you're diagnosed with COVID-19 or you're seeking a diagnosis or you're subject to a government isolation order, that's self-leave. But if you're a caregiver for someone else that's facing those same or similar circumstances, that's going to be labeled as leave to take care of family. Now, the key here is, and why it's important to distinguish between these 2 buckets, is that if an employee's reason for taking leave is in that first bucket of self-leave, they're eligible to receive 100% of their wages, again, up to that 80 hours. And that will be capped at $511 per day or $5,110 total per employee. Now, if the employee is in the second bucket and can't work or telework because they're taking care of someone else, then they're only entitled to 2/3 of their regular pay. And then the cap is lower, again, back down to that $200 per day or $2,000 per employee. All right, so on the next slide, we will get into those credits that are intended to subsidize the cost for employers to provide those paid sick and paid family leave benefits. So the Act created a series of refundable payroll tax credits that employers can claim, and it's going to be on a quarterly basis on those qualified wages paid through 2020. Now, in addition to the amounts paid related to sick or family leave, employers will also receive a credit for the amount of qualified health plan expenses and their portion of Medicare tax allocable to qualified leave. Also, any sick or family leave wages that are paid under the Act are exempt from the employer's portion of Social Security tax. Just a note, self-employed taxpayers, they're also eligible for a refundable credit, and it's going to be against their income tax paid on those self-employment earnings. The IRS has released guidance indicating that employers will be able to decrease the amount of payroll tax that they remit equal to the amount of credit that they expect to receive under these provisions when they file their quarterly payroll tax returns. And we've included a link to the IRS FAQs related to the Families First Act credits on this slide. And in addition, the CARES Act, which we'll talk about later in this webinar, it also includes a cash flow relief mechanism for companies that are eligible for these credits. All right, so on the next slide, we will go ahead and take a bit of a closer look at these credits, these paid leave credits. So the paid sick time payroll tax credit, again, it's going to be limited to that $500 or $511 per day or $5,110 in total per employee if an employee is taking time off to care for themselves. So that's situations 1, 2, and 3 on that previous slide. Or it's going to be $200 per day or $2,000 in total if that sick leave is to care for an individual who's quarantined or showing symptoms of COVID-19, or they're caring for a minor child whose school or daycare or other form of childcare is unavailable, again, due to COVID-19 precautions. And that's situations 4 and 5 on that previous slide. So for employers that pay family leave wages under the Act, and this is that second column on the slide here, a separate payroll tax provision allows a credit of up to $200 per day, $10,000 in total per employee for employees that are requesting leave to care for a minor child whose school, daycare, or other form of childcare is unavailable due to COVID-19 precautions. And again, that's situation 5 on that previous slide. And as we mentioned previously, that expanded family leave benefit is available for 12 weeks. However, those first 2 weeks are unpaid unless covered by another benefit. So that's where that total cap of 10,000 comes in. It's 10 possible weeks of paid leave at $200 per day. Now, just real quick, notice that in any situation where the employee isn't the one directly affected by the virus, the employer is only required to pay 2/3 of the employee's regular pay. Now, again, the employer can pay the employee more than this amount, but they're only going to be subsidized for that 2/3 that they were required to pay. All right, so to help demonstrate how these credits work, we're going to move into a couple of quick examples. So in this first example, we have Sally. She's a full-time salaried employee who's unable to work either from the office or remotely, so she can't work from home either because her 8-year-old's school is closed and she doesn't have anyone else who can help watch her child. Her annual salary, we'll assume, is $100,000 and she's unable to work for 9 weeks. We'll also assume for purposes of the FMLA credit that she's been with the company for at least a month. So first of all, notice that Sally's reason for being unable to work, it's going to fall under both the paid sick leave and the expanded paid family leave provisions. So because of this, she'll be able to use up to 2 weeks of that paid sick leave during the 2-week unpaid period under those family leave rules, in addition to being able to use up to 10 weeks of paid leave under the expanded family leave provisions. And also, it's important to reiterate that the employer, again, can pay Sally more than that, the 2/3 of her normal salary in this situation, but they're only required to pay 2/3. So in this example, if the employer pays Sally 2/3 of her normal salary, which comes out to about $256 per day, it would be over the daily cap of $200. So therefore, Sally's leave pay and the employer's credit on that pay would be $200 per day for 10 days or 2 business weeks of sick leave, and then $200 per day for 35 days or 7 business weeks of paid family leave. Okay, so on the next slide, we will look at one more quick example. And here we have Joe. He's a part-time employee who's requesting paid leave for 2 days because he has to self-quarantine at his doctor's advice. And Joe is normally scheduled to work 4 hours per day, and he's paid $15 per hour. First, we need to determine which type or types of leave that Joe is even eligible for. And his situation, if you recall, will fall under that second condition that we showed on that previous slide. So a healthcare provider has advised him to self-quarantine because of COVID-19. So accordingly, he's going to be eligible for paid sick leave for those 2 days that he's unable to work. In addition, that paid leave is subject to a higher cap than if his leave was related to caring for another person. Now, he's not eligible for the expanded family leave in this situation since he's not caring for a minor child. And in this example, Joe's daily wage is below the cap, and so he's eligible for total paid leave of $120, which is fully subsidized for his employer. Now, for both of these examples on this slide and the previous slide, keep in mind that the employer would also be able to claim any qualified health plan expenses and the employer's portion of Medicare tax related to those wages as an additional credit. And you may be thinking these examples are pretty simple. We're only looking at one employee at a time. And the computations are complex and they're somewhat confusing. So we encourage you to reach out to your tax advisor on help with these calculations. And actually BKD, we've developed a model that will help our clients calculate their payroll tax credits and then the associated wage exposure under these new rules because we realize it's pretty complicated. And so we're trying to help out any way we can in that perspective. Yep. Yep, so next we're going to move into some commonly asked questions that at least we've been getting so far. So we imagine that if we're getting these questions, you guys may be either getting these questions or have these questions yourself.
Yeah, and you know, one, I think, Julia, we've been getting a lot of this one is just that whole employee account, particularly, you know, the 500 employee threshold, and you know, what if I'm a business that has multiple entities? So I own multiple entities that each individually may be below 500, but do I have to aggregate and look at the total when I'm doing my 500 threshold count to see if I'm under the required pay rules under this provision? And there is actually a very good FAQ on one of the previous slides. I think Julia had a link to the DOL FAQ page that does address this question, but really it is not as simple as it may seem. There are some rules under the Department of Labor, the Family Medical Leave Act rules, where you may have to look at certain multiple entities and aggregate them based on control and what's called an integrated employer test that may require you to combine those. And that's where we're really advising clients and businesses to make sure they're consulting with their employment law attorney that's familiar with the DOL and FMLA rules, because this is an area we need to make sure you understand and if it applies in your situation. Another one kind of along the lines of the employee count is the under 50 employees and the potential exemption from these rules. Many businesses that may only have 20, 30 employees, this could be a very difficult thing for them to implement. And obviously from a cash flow perspective, if they have to make the payments but may have to wait to get the cash, the subsidy from the government through the payroll tax or other mechanism, it could really put a strain on their ability to continue as a business. So there is also on the FAQ page some guidelines that the DOL has put out as far as how do you qualify for an exemption from these rules if you're under 50 employees. Another question that's come up quite a bit is on the next slide, Brian. Do these rules apply to layoffs or companies that are shut down because of their main source of income? And the answer is no. These paid leave provisions are meant to be temporary leave for employees who can't work because they're sick or taking care of somebody because of minor child, the school closed or daycare closed. They're not meant to provide relief for those who are laid off or furloughed. Just need to make sure that understand that if employees are laid off, then this does not apply. This would only apply to workers who have to stay home and can't telework to perform their job. They could be eligible for these benefits. Then the next question we're getting is what about payroll tax on these wages? For tax purposes, these are still taxable wages to the employee and subject to Social Security and Medicare. From the employer side, though, the employer portion of the Social Security on these wages are exempt, so they are not subject to Social Security. And while there is a Medicare tax piece still due from the employer, they do get to add that basically as an additional credit that they get to take. So essentially, you don't pay Social Security from an employer aspect, and you get the Medicare tax reimbursed through the credit. And then the last common question here on this act is does this mandatory sick leave replace existing sick leave policies? And that answer is no, it does not replace existing leave policies provided by employers. So if eligible, employees may choose whether they want to use their employer-provided benefits, such as accrued vacation, or if they want to use the sick paid leave under the Families First Act. So an employee may choose to use both their accrued paid leave from the employer and this mandated sick leave. But know, however, that you're not entitled to a tax credit for any paid sick leave or expanded family and medical leave that is not required to be paid or exceeds those limits that Julia mentioned. Also note, you're not required to permit an employee to use the existing paid leave to supplement the amount your employee receives from paid sick leave or expanded family and medical leave. And then lastly, you may not claim and will not receive a tax credit for such supplemental amount. So again, kind of back big picture is basically, while there is a mandate, this is required for certain employers, the intention is this is essentially a government subsidy through the employer, and the employer does essentially get reimbursed at least for the required amount through the payroll tax credits. So it's been a lot of complexity there and so forth, but and I'm sure there are many questions, and certainly we'll try to address ones that come in today or after this webinar. But just be aware that that is definitely provision that could definitely apply to a lot of businesses under that 500 employee threshold. All right, I think Julie, now you're going to get into the CARES Act, so I'll turn it back to you.
Yep, thanks, Jesse. And I will mention real quick that those were just some of the commonly asked questions that we're getting. If we have time, hopefully we will have some time to cover some additional questions that are specifically on your mind in the audience, but those are just some of the ones that we've been getting so far. All right, so moving on to the CARES Act. So on March 27th, President Trump actually signed into law and it's the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act. And this is the third stimulus bill that was enacted to help provide emergency assistance for individuals, families, and businesses that are being affected by COVID-19. Now, if you're hearing talks of those checks being sent to taxpayers and the small business loans, this is the piece of legislation that's seeking to provide those benefits and has actually been enacted to start providing those benefits. All right, so first we're going to begin with the provisions impacting individual taxpayers on the next slide. So the CARES Act provides for one-time recovery rebate checks of $1,200 per employee, per individual, and then $2,400 for married couples that file jointly, plus another $500 for each qualifying dependent child. And under the Act, that's defined as a child under the age of 17. So that means that adult children that are being claimed as a dependent on their parents' return, for example, college students, they're not going to qualify for a recovery rebate check. These checks are expected to go out as soon as Treasury and the IRS are able to process them, which at this point is likely to be within the next 2.5 to 3 weeks. And if the IRS has your direct deposit information from a previous filing, you should expect to receive your recovery check electronically. And then for everyone else, the IRS will send out a paper check to the last known address for the taxpayer. The amount of the rebate that a taxpayer will receive is based on information that's reported on the taxpayer's either 2019 return or on their 2018 return if the taxpayer has not yet filed their 2019 return, which is entirely possible given the tax day postponement. So for individuals who did not file a return in either 2018 or 2019, the IRS has stated that they'll use the individual's 2019 Social Security income, which they have access to. Now, this rebate is technically an advanced credit, so you will need to recompute their credit on your 2020 tax return, but it doesn't appear that this isn't intended to make it so that taxpayers have to repay any amount they receive in excess of the credit based on their 2020 income, but that's currently how it's set up to work. Now, not everyone gets a check. However, you'll need to have provided a valid Social Security number for yourself, your spouse, and then any qualifying children that you're claiming. And then those who are claimed as a dependent on another's tax return also won't be receiving a payment. Additionally, there are various phase outs for higher income taxpayers. And then once you're over those stated thresholds, you'll end up losing $5 of your payment for every $100 that your income exceeds those thresholds. And we've included, sprinkled kind of throughout this presentation, and here's another one, a link to the IRS FAQs that are related to these payments. All right, so on the next slide, we'll move into some of the business provisions within the CARES Act. Now, if you think back, the the Families First Act provided payroll tax credits to companies based on whether their employees were personally affected by COVID-19. Now, on the other hand, the CARES Act comes in and provides an employee retention credit, and that's based on the economic strain that the disease may have on a business. And the rules for calculating this credit are, if you can imagine, even more complex than those for calculating the paid sick and family leave credits under the Families First Act. But essentially, eligible employers are going to be allowed a refundable payroll tax credit that's equal to 50% of any qualified wages paid. And those qualified wages are limited to $10,000 per employee. So it's a maximum credit of $5,000 per employee. And the employee retention credit is intended to cover situations where a business is either fully or partially suspended due to governmental orders, or it's experiencing gross receipts that are less than 50% of gross receipts received in the same calendar quarter in the prior year. And again, the IRS has recently released a series of FAQs on the employee retention credit, which clarifies some of the aspects within the new provision, including the fact that an eligible employer can actually fund the qualified wages by accessing federal employment taxes that they have set aside for deposit with the IRS for other wage payments that are made during that same quarter. And as mentioned previously, the CARES Act also provides some additional payroll tax relief by allowing employers to delay remittance of their share of Social Security tax that would have been deposited through December 31st of 2020, so through the end of this year. And instead, 50% of those taxes must be deposited by the end of next year, so by the end of December 31st, 2021, and then the remainder will need to be deposited by December 31st, 2022. Now, a key note to make here before we move on is that if an employer receives a small business interruption loan, which we'll talk about next, they're not eligible for the employee retention credit. Also, if they've had indebtedness forgiven under the Small Business Act, they're not going to be eligible for that additional payroll tax relief provided by the CARES Act. So we strongly recommend that businesses work closely with their tax advisors, their business advisors, to help analyze the trade-off between these two benefits, since they are mutually exclusive here. All right, so a couple other, sorry, can you go back to the last slide? Just a couple other things. The CARES Act also includes a fix to the retail glitch, so the technical correction that was needed to allow qualified improvement property to be eligible for bonus depreciation, and it also made a few modifications to the net operating loss rules. All right, so for the sake of time, we're going to go ahead and move on to another hot topic of the CARES Act, the small business relief provisions.
Yeah, hot might be a bit of an understatement. It's there's just been a flood of interest, and rightly so, for many businesses on this Paycheck Protection Program, or the PPP program, and that was another big part of the CARES Act in terms of providing more relief for small businesses. So there's $349 billion that was allocated to this program that's being administered by the Small Business Administration, the SBA. But essentially, these are loans that are going to be given to qualifying employers, again, typically those with not more than 500 employees, to help with reimbursement of wages to employees, as well as certain rent, utilities, interest payment on debt during a covered period, basically February 15th through June 30th, 2020 is this loan period. So what it is meant to do is to help businesses have the cash to be able to continue keeping employees on their payroll and paying the bills through this crisis. The loan amount is 2.5 times of an employer's average monthly payroll, and so you can get a loan of up to $10 million maximum. And the really key feature of these loans is there is a forgiveness feature that allows for certain costs incurred during this time frame to essentially be paid for by the loan, and then the loan forgiven. And then better yet, that loan forgiveness is not treated as taxable income like it normally would be when you have relief of indebtedness. So it's a really a nice program to be able to help fund some of these costs. There is a page on the Treasury website there that talks more about this loan program. But as Julia mentioned, one of the key things to keep in mind is there is an analysis that needs to be done between this program and the employee retention credit and the payroll tax deferral provisions, because those cannot be combined. So if you take a loan under this program, you're not able to take those credits. So there, really need to look to see which one is going to provide the bigger benefit for me longer term to be able to get funded and have the cash to help pay some of these bills throughout this crisis. The other big thing to keep in mind under the CARES Act, and these are not necessarily new, but they're emergency disaster assistance loans. On the next slide there shows you some details on that. But this is also another program to help with funding, providing up to $2 million in working capital loans. The terms of those are typically up to 30 years, a fixed interest rate for profits of 3.75. This is also administered by the SBA, so they have a web page there on the slide that you could go to learn more about them. But one of I think the key things to remember with these loans is there's also an emergency grant feature through 12/31 of this year where you can quickly fill out in advance, essentially request of up to $10,000 through their website, just through some self-certifications and so forth. And they are saying that should be funded within 3 days after the SBA receives it. And even if you don't get approved for one of these disaster loans, you're not required to pay that $10,000 back. So again, it's something to keep in mind as an additional funding option under these SBA programs. And I think next slide, Brian, there is a lot of additional discussion going on out there in terms of what's next, what's coming down the road in terms of additional relief. Certainly, there's a lot of guidance we're expecting from Department of Labor, from Treasury and the IRS in terms of implementing all these different provisions. There's already talk about the Phase 4 bill, which likely will be headed by the House this time in terms of developing that legislation. Probably the emphasis, at least what we're hearing now, is more emphasis on workplace protection for our frontline healthcare people, more direct financial assistance to taxpayers, and then a lot of discussion on infrastructure. That's been a big thing, bipartisan agreement that we need more infrastructure investment funding. But really the key in the past has always been how are we going to pay for that? And given the fact that CARES Act was $2 trillion, I'm not sure that's a big concern right now of Congress in terms of how we're paying for this, because really the goal right now is the government to get as much money into the system as possible to help us get through this crisis. Okay, if you need more information, there is a slide there with a link to our webpage on our website, bkd.com. We do have a resource center with a lot of different alerts and thoughtwares and links to different webinars. And I know I just briefly touched on it, but on the next slide there is some information on these SBA loan programs as well as the retention credit. There is one actually this afternoon from 2 to 3, but I believe that one is actually filled up. So we are doing a rebroadcast of it tomorrow from 2 to 3 Central. So you can certainly go to our website and register for it. It's no cost, so it's a complimentary. But definitely encourage you, if you have further questions on that, to attend that webcast tomorrow. And as Brian mentioned, we're looking at providing a separate webinar for this group next week, particularly on these programs. Okay.
Thanks, Jesse. Just absolutely wonderful information, and I think you covered it very well. There are a lot of questions, and I know that a lot of our folks on the line are really focused on that the PPP side of and the SBA loans, so the emergency assistance loans. As Jesse indicated, we didn't. We're gonna schedule some more time next week for all of us to go through that. In what's happening in the environment today is that how they're going to be enacted and how you're actually going to be able to work through these things is changing on a daily basis, and we should have better guidance, through into next week, and we'll have more, some experts on that those subjects cover it for next week as well. So with that, I'll jump into some Q&A with the group. And our first question for you guys is, I'll handle the first few for the Families First Act. The first one says, does a state government stay-at-home, stay-safe mandate qualify as a quarantine order under option 1 for the emergency paid sick leave? So I don't know if Jesse or Julia, you can cover that one real quick.
Yep. Sorry, I was on mute.
Okay.
Yeah, so as far as we can tell, no, that wouldn't be covered. So the Families First Act, those provisions, basically in the name there, paid sick leave. So it's, I believe the intent is that the individual themselves are needing to be quarantined or isolated because they are either personally affected or they're experiencing those symptoms to try to stop the spread in that way. On the other hand, if the business is subject to kind of a global stay home, stay safe mandate, and they're not an essential business, so they have employees that aren't able to either come into work or telework. I think that's a big key too that I want to reemphasize is a lot of these things are based on whether the employees are able to work, period, whether they're able to come in or they're able to work from either a home office or another location. That's what qualifies as not being able to work. So possibly under the employee retention credit, but as far as I can tell, that's not going to rise to the level of a quarantine order.
Okay. So our members, are considered essential in the business, right? So if they're able, we're there, we're considered essential. We've enabled people to work from home, and those that are essential to be on site are on site. So in theory, all those people do qualify, or could qualify. But then it comes, if they're quarantine order under the state, that would allow them to not qualify. Is that what you're saying essentially?
Yeah.
Okay.
Yeah, Jesse, would you agree with that?
Yes, I think that would be our interpretation as it stands now.
Yep. Okay, great. And I think you may have addressed this. One of the questions coming in was talking about how the sick pay and the emergency FMLA can they be taken intermittently? And if you could summarize just real quickly again how those two interplay.
Yeah, the key here is, well, first of all, yes, they can be taken intermittently. The kind of definition of what intermittently means, it kind of changes the answer. But essentially, as long as the employee and the employer can come to an agreement as far as the working arrangement for the employee, yes, it can be taken intermittently. And it's easier if the employee can work remotely, they can be paid intermittently in any increment. So they can take, if they're able to work one day from home, but then the next day, like their childcare is unavailable, then they can't work from home. That can be an on and off kind of daily thing. If they're unable to come in because they are sick, then you can't really have that intermittent, one day you're able to work, one day you're not, because obviously you're not going to be less contagious from one day to the next. So that's kind of a difference there. But as long as the employer and employee agree, basically any arrangement can be worked out.
Okay, great. So we do have a lot of questions. So I'm going to we're probably going to run over just a few more minutes. It's on the 1 o'clock hour now, but I think it's a very important topic. So we'll continue down the question paths. We still have 98% of the people that started. So we'll just keep going. We'll go a few minutes long here for those that are looking at the time clock. So a quick one, I think, again, the Families First Act, for those of us using a payroll company, paying the taxes as well, like ADP or Paychex, do you know if they are working with clients to get the payroll credits?
Yeah, I think at least what I'm hearing from our accounting outsourcing people who deal a lot with our different payroll providers, this is something that ADP and Paychex and others are very much familiar with and are working with their clients to be able to get these credits. Certainly, IRS still needs to provide the forms, the actual updated payroll tax forms in terms of how do you claim the credit and so forth. So this is something I know Paychex and I'm sure ADP and others have had separate webinars on with their clients and so forth. But certainly, if you use one of those providers, definitely reach out to them and see what they can do or what they are doing to help be able to take advantage of these credits. And I think, as Julie mentioned as well, if there is concern about in terms of having the funds right now versus when you file your second quarter payroll return, there is a form out on the website now, form I think 7200, that can be completed to essentially request an advance of that from the government if you otherwise don't have other payroll deposits that you can take and use to pay that sick leave.
Okay, so I have just received one more for the Families First Act, and then we'll move on to the CARES program a little bit more in depth. So it's a hypothetical. So say an employee is sick, the doctor places them in quarantine. They come back to work for 3 weeks and then are out sick again and placed in quarantine. Would they need to pay that individual twice under the FMLA guidelines?
Yeah, that's a good question. So the bucket of time that you're the leave time that you're allocated doesn't start over, it doesn't replenish. But if your qualifying reason, so if you're sick, you get better, and then a few months later, a few weeks, whatever the case may be, if that qualifying reason comes back, you are able to use the remainder of any leave that you didn't use up earlier in the year.
Okay. Great. All right. So, excuse me a second. Moving on to some more of the payment protection and CARES Act side of it. Okay, so this is regarding the payroll tax deferral provision, right? So that have to be paid at the end of 21 and 2022. Can that be utilized with the payment protection loan program, or can a company only pick one or the other?
Yeah, so we talked a little bit about this in the presentation. So there are limitations under the CARES Act for which provisions you can kind of mix and match together. So for example, the deferral of payroll taxes to 2021 and 2022 is specifically not available for an employer that's participating in the Paycheck Protection Program for small businesses. And then also, the employee retention credit isn't going to be available for any employer that's participating in the Paycheck Protection Program as well. And in addition, any wages that are used for the employee retention credit, you can't double count those and use those for other credits like the work opportunity tax credit and things like that. So there's some that can be used together, but then there are some, specifically the ones that are under the CARES Act, that you can't double count those.
And one thing I might add to that, Julie, and I think maybe to help clarify another question that I saw come in, there is some trade-offs you got to think about between the PPP program and employee retention. There was a question about that $10,000, the EIDL program, and just to be clear, that $10,000 grant, that is not something that you have to trade off against the PPP program. So if, let's say, I do apply and take a grant of $10,000 and get an EIDL loan, that does not prohibit you from also participating in the PPP program as well. What it will do is it does reduce the amount of eligible loan forgiveness that you'll otherwise might get under the PPP program. So there is a bit of a trade-off there in terms of I get this grant, but I can't use that $10,000 as part of my covered cost to get loan forgiveness on that. So I just want to make sure that's clear distinction. Those two programs can be done together. However, you can't do those programs and the employee retention and payroll deferral.
All right, thank you. That's very good. So we have a host of other questions coming in, but I'm going to zero in on a couple there's a lot of interrelation here. for those questions that we did not answer on the phone today, we'll catalog them and try to get an FAQ document out to everybody. Again, posted on our website. So there are a lot of questions about flexibility. So when I say that, what I mean is that maybe someone is scared to come into work, so they have to kind of flex those people in and out, or they want flexibility to kind of limit exposure. For example, alternating employees inside the building and out, and then maybe the next week they kind of flip those around. But closing a few hours early a day, things like that. So there's a lot of different types of implementation of how people are working with their employees. How does that affect their ability to work within some of the loan forgiveness programs and things like that? A lot of the questions really are around that loan forgiveness. And I know we're not covering that very in depth today, but how does that change the loan forgiveness programs?
Yeah, one of the keys with the loan forgiveness with the PPP is the intention is with this loan forgiveness, it's meant to try to encourage employers to retain employees during this period versus laying them off and sending them to unemployment. Although, like I'm sure many of the attendees are seeing or hearing, some employees are probably saying, well, I make more money if I'm unemployed because I get not only the state unemployment, but there is also part of the CARES Act, basically an additional $600 per week kicker that they're going to add to your unemployment. So there's certainly some challenges there in terms of retaining employees who might otherwise feel like they're better off staying unemployed than collecting unemployment. But really the key to that loan forgiveness is what is your employee count during this period or as of June 30 compared to kind of the prior period average. And as long as you're maintaining a certain level, then you're eligible for more forgiveness. So really it looks at how many employees are you retaining during that period. And certainly this is not an area that I'm deeply familiar with, and I'm sure there'll be some better responses or answers either on our webcast tomorrow or the next week's program. But yeah, that's really the key though, is looking at your employee levels and are you maintaining similar levels to take advantage of the forgiveness.
Yeah. Okay. That's great. So I'll close it on one more question and then just one comment to everybody. There's been a lot of conversation or a lot of questions around workers' comp numbers be used in the PPP calculations. If we have people that leave on their own volition and then I hire people back in, what does that do to our PPP calculations? Things like that. We'll get those answers to you, and we will definitely answer them for you on the next webinar for sure. But we'll see what we can do to get answers in the meantime before our next webinar as well. So before we get cut out, one more question. It comes around. There's a lot of our businesses, a lot of our members that have already potentially laid off a few individuals, right? There's been some discussion that as long as they bring those people back prior to June 1st, that'll be okay, and the forgiveness programs they'll still apply in the forgiveness programs. Can you expand on that a little bit? Is that correct? And what are those requirements around maybe we've already laid some people off, and how does that interrelate to the SBA loan forgiveness?
Yeah, that's an interesting question, and certainly one that others have observed, because yeah, the way it's written, it does appear even if you do lay employees off for a period of time, as long as you bring them back, I believe by the June 30, which is kind of the end of this covered period, and get those employee numbers back up to the comparable levels, then it shouldn't impact your loan forgiveness. So that's maybe a pretty basic answer, and I unfortunately probably don't have all the details, but can certainly follow up with some additional details and background as far as those actual calculations. But again, it's unfortunately, I think tomorrow the SBA that program opens up. So many questions in terms of how this works, and really what we're hoping to see here soon is guidance from Treasury to help better understand these rules, because right now, we're all kind of reading from the actual legislative text. If anybody's had the pleasure of reading, legislative text, it's not always the easiest to comprehend. And there's certainly some drafting errors and so forth that we need interpretation, from Treasury or others, or at the SBA to be able to clarify. So certainly, we can provide what we know now, but certainly there might be some of those questions that will be addressed further down the road once we have a little bit more clarity in terms of the program.
All right. Well, I appreciate that, Jesse, and you make a good point. It's what, a 883-page document that everybody had 24 hours to review. So I'm sure there's some interpretation issues there. So.
Oh yeah.
Yeah. Well, all right. So I'm gonna close out the webinar. We really appreciate you guys taking the time today. BKD, it was great information. I think we could talk about this for days, as people are doing anyways. And we'll get this recording out to everybody over the next couple of days here, and we'll send an invite for the next webinar as well. Thank you guys, and thanks for everybody for attending. Everybody have a great afternoon, and we'll talk to you soon.
Thank you.
Thanks.